Hey, Dan Passarelli here. How are you feeling today? I hope you're feeling great. Today, we're going to talk about something super important. We're going to talk about why your covered calls don't work. I want to make sure you can hear me. If you can, please go to the Q&A box and let me know your favorite color. What's your favorite color? Green. Ah, Justin, you'd be right at home here. Howard, blue. Mike, orange. Dirk, green. Dirk, you're invited too. Come on over. Michael, blue. All right. Well, before we get started, I need to point out options are not for everyone. You should read characteristics and risks of standardized options before trading. Get a copy of that by emailing investor services at theocc.com. Don't trade with money you're not prepared to lose. And everything we're doing here is providing generalized information, not necessarily specific to your situation. Pink. Oh, Martine likes the pink. We had some other colors too, but I deleted them. Sorry. Okay. I see some new, fresh faces here. I don't really see your face. I just see your names. So I see some fresh names. For those of you who are already old friends to the Market Taker family, hello, good to see you. For those of you who are new to the Market Taker family, my name is Dan Passarelli, and I'm an author of two of the most popular option trading books, The Market Taker's Edge and Trading Option Greeks is the one I'm most known for. I also write lots of articles. I'm quoted often in financial press. I get to be on TV sometimes and put out a daily video, write on my Substack, have a podcast. Oh my gosh, I got to slow down. I got to stop doing all this stuff. But while I'm doing it, take advantage of it. I'm also a trader, traded professionally on the floor of the Chicago Board Options Exchange for many, many years. And now I trade in a regular retail trading account just like you. And I've been in options since 1993. Yeah, I am an old guy here. That's why I need to take my lion's mane. I forgot to take it this morning. Okay, so I am the founder and president of Market Taker Mentoring, which is the global leader in option trader education. Hey, how are you, my friend? Apalabi. Welcome, welcome. Um, we have students in over 50 countries. We've put just a ton of students through our programs. Through our programs, my Chicago accent's coming out. I get accused of having a Chicago accent all the time. Um, yes. What else? I'm also a trading industry collaborator. I work with all the good options friendly brokers out there, like, for example, Firstrade and most, if not all, of the options exchanges globally, and software companies and financial press and blah, 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 blah. I've just been in this business for a long, long time, so you kind of get to know everybody. Outside of trading, I do other things. For example, I am a family man. My wife, Kathleen, who many of you know, she runs operations here at Market Taker Mentoring. My two adult children, my two cute little dogs. And I am a runner, foodie, traveler. Me and my family enjoy traveling. I also travel a lot with John Kamisik, who's our head coach here at Market Taker. and I'm a music person. Okay. Now, I mentioned my podcast before. You're here because you want to get better at covered calls and find out, hey, how come these things don't work as well as they're supposed to? Well, I've got just the podcast for you. Literally, I have got just the podcast for you. It's called Wealth Building with Options, and it is designed to help you master covered calls and cash secured puts, which we call the wheel. So it's great for wheel investors of all experience levels, from beginners, because I kind of start at the beginning with episode one, all the way to very advanced people. I also do consulting projects with professionals sometimes. Adjust, also, we cover adjustments, mindset, strike selection, analysis, and more. In fact, oh my gosh, I just had, wait, where's, I've been reading a book recently. My most recent podcast episode, if you're interested in mindset stuff, oh my gosh, I had a special guest, Denise Schull, on, and goodness gracious, that woman is just really darn smart. Oh, goodness. She's great with trader psychology and stuff. I put that up there as among our best episodes. And what else? What else? What else? We have new episodes weekly, once a week. In fact, the latest one with Denise just dropped this morning, now that I think about it, like 2 hours ago. And the best part of it is it's free. You can get it on any podcast platform. Apple Podcasts, you can just go to markettaker.com/applepod, markettaker.com/Spotify pod, or just go on your favorite podcast app and search for Wealth Building with Options. And I think you're going to like it. We get a lot of good feedback from that. Okay. Covered calls, friends. This is, so I think I mentioned, I'm just finishing up a book on covered calls and cash secured puts. That's why I have the podcast. And covered calls and cash secured puts, we're just talking about covered calls today, but that's like its twin brother. Covered calls are the very simplest strategy, but like anything, if you want to get good at it, it requires some nuance. At its base level, it's owning shares of stock and selling call against it 1-to-1. So 100 shares long, one call short, because each call represents the rights on 100 shares. This is an investor-oriented strategy. So not a trader-oriented strategy, but an investor-oriented strategy. And I make that important distinction. It's generally considered a very conservative investor strategy. So here's the thing. Look, here's the big thing when it comes to covered calls. They are shown to outperform just simply owning stock. There's numerous independent white papers and academic studies out there that prove that. But not just outperforming the buy and hold, but also lowering the standard deviation. You know how they say, oh, well, if I want more reward, I have to get more risk, right? This is a very, very special strategy where we can actually get more reward and less risk. It improves what we call the Sharpe ratio. But here's the problem. Most people do it wrong. It's this simple strategy. I own stock, I short a call, but almost everybody gets it wrong, at least when they first start. So we're going to give you a pretty good crash course on some of the things to think about that can help you get you over that hump. And then, listen to the podcast too. This is a way to generate income on low volatility stocks or ETFs. It's a way to lower the cost basis of stock, not for tax purposes, but for mental accounting purposes, and a way to potentially set an exit strategy for a stock or an ETF. So, covered call, I think, is sort of like the broadest term, but I like to make a distinction. We can buy stock and sell call as one single trade as a spread, or we can do it as two trades where I already own a stock and then I sell a call. Either way, it's covered call, but I like to kind of narrow in a little bit and say if you do it as one trade, it's a buy right. If you do it as two trades, it's a covered call. And one of the reasons why that's important is because with most of my covered calls, I roll them. Because here's the big secret. Any one covered call trade, it might make money, you might lose money, who knows? But when you do it as a system over and over again, methodically, that's where it can make money. And it's because when done correctly, the system has an edge. Imagine that you are a casino operator. What would you rather have? Like, let's say you're going to accept $10 million in bets. Would you rather have one person walk in the door, make one $10 million bet on blackjack or roulettes or whatever? Or would you rather have a million people come in and make $1 million $10 bets? You would rather have the second. Why? Because even if you have an edge, in something like blackjack, your edge can be like 1.4, or the casino's edge can be like 1.4%. Depends on the specific rules. But I mean, the guy or gal could get lucky who's betting. A 1.4% edge is not a very big edge. If it's one trade, if it's one hand, you're either going to win or lose. But if it's a whole bunch of hands, the casino is going to make money. This is the nature of covered calls. Don't forget that. Must be traded as a system. So let's say that I want to buy a steadily rising stock as a conservative long-term investment. Now, I'm going to throw you in a bunch of bonuses here today, okay? I'm going to throw you in a whole bunch of stuff that's not actually even in the presentation, because you know why? Because I want to help you. I want to help you be great at this. These are the things that I talk about on my podcast. Why might I want to buy a steadily rising stock as a conservative long-term investment? Is the answer because, I don't know, it's been going up, maybe it'll keep going up? No, but that is a lot of people's answer, but that's not a good answer. We need to look at it from a technical and or a fundamental standpoint. We need to do technical analysis and or fundamental analysis. We also need to do volatility analysis, but that's something a little bit different. I'll try and work that in towards the end too, throw you a bonus on that. So what are we looking from a technical standpoint? Well, we're looking for maybe some of a couple of things. One, a stock that has bounced off support and is heading back higher into its range. A stock that has in RSI above 50, but not above the 70 line into overbought territory. Or just in an uptrend. How do we define an uptrend? Higher highs and higher lows. From a fundamental standpoint, and this is where I hope you're taking notes. If you are a very well-versed and well-read and well-practiced fundamental analyst, you're going to calculate what we call the intrinsic value of a stock, which is different than an options intrinsic value, a different use of the word. And we could do a whole 4-part webinar series on this, if not more. So I'm just going to leave it as homework for those of you who want to get more into that. But if you don't want to put in all that effort, there are some key fundamental ratios that can really benefit you. One, super easy. The PE ratio, price to earnings ratio. You can look at the TTM, trailing 12 months, which has the advantage of being black and white. We know exactly what these numbers are because they are past numbers. The disadvantage is it doesn't take into account expected future growth. Or we could use the future PE ratio, which has the advantage of taking in expected future growth, but has the disadvantage of being somebody's best guess, not black and white. We also use book value. We like to see book value under one, not book value, but the price to book ratio, I should say, under 1 if we can. We also like to see the price to cash flow ratio. We like to see that as low as possible. And we also like to look at the quick ratio to get an idea of how liquid a company is so they might not run into a cash crunch. Whew. That's a pretty good starter kit for you. If you wrote all those down, you got a little bit of research to do. And like I said, if you want to do it the easy and fun way, I talk about it on my podcast all the time. You can do that while you're driving, while you're running. It's just an audio podcast, so you don't have to be in front of a screen. All right. So we want to lower our standard deviation. We want to have as low a cost basis as possible, and we don't expect the stock to break out. We like a huge shoot upwards. We expect it to steadily grind higher. So here's what we're going to do. We're going to buy 100 shares of this stock at $70 a share. And at the same time, sell the 75 call at $2 a share. Okay. So what are we really doing here? We are selling somebody the right to buy these shares from us at $75 a share on or before the expiration date. Now, I have March here because I do these presentations all the time, and it's just easier once you get a really good PowerPoint put together. You just keep it and you can reuse it and throw in some bonus material if you're in front of an audience that you like I like you guys. So the question becomes, hey, is March the right expiration for me? Right now, if you're listening to this live, maybe not. The sweet spot is usually anywhere between 1 week and 6 weeks. I do sometimes go out 6 months, sometimes go out a year, um, sometimes 2 years. But most of the time, you're going to get the most benefit 1 to 6 weeks until expiration. Now, Howard asks a pretty good question. Why not sell the 70 call? There are some times when I would do that. I throw as much information at you folks as possible today here. The reason why I am writing a book on the topic is because it takes a whole book to explain all the things I need to. There are definitely some times when I sell an at the money call, 70 strike. And we're going to talk about some of those times. I actually have this broken down later into in the money, at the money, or out of the money calls. Ooh, did you see how I did that in the money? Oh, yeah, we'll talk about that. So in this case, I'm selling somebody the right to buy the stock from me at $75. And I'm collecting $2 for selling somebody that right. So wait a minute. Let's think about this. I buy, or maybe I already own the 70 strike calls. And I'm telling somebody, hey, look, you can buy the stock from me at 75. Anytime between now and this date. No problem. So far, actually, so good. I'm saying, hey, I'll take a $5 profit on this stock. No problem. I mean, what does that come out to? About 8%, right? No problem. So far, that's pretty good. I mean, how many times have you bought a stock and just worked a limit order to sell it? Good till cancel limit order or something. I do that all the time. I got GTCs in right now. I probably got about 15 of them in my IRA. But to boot, we're actually getting paid to work this limit order. How about that? Okay. So our plan is we want to hold the shares after March expiration. Now you might say, well, why would you sell somebody the right to buy the stock by March expiration if you want to hold it after March expiration? We'll get there. Okay. I'll steal my own thunder. It's because we plan to roll. We plan to continue this. This is, they call covered calls and cash secured puts the wheel strategy. And think of every one trade in a covered call or cash secured put as one cog in the wheel. You know what a cog is? It's like if you picture gears, you know how gears go like this? Each one of those little nodes, bumps on the wheel is a cog. Every one trade is just one cog in the wheel. This stock might go to 40 and I might lose money. This stock might go to 100 and I might end up selling the stock at 75 early. The one trade, just like any one bet at a casino, doesn't matter. When I trade this as a wheel and trade many, many cogs, that is where I'm really. So let's explain exactly how this works. Okay, so I'm long 100 shares of the stock from $70. I sell short one March 75 strike call at 2. That's when you say, bless you. Get it? At 2. All right, I know. I'm not really funny. I don't get paid for my funniness. Thank goodness. All right, so here's what we do here. If the stock is above 75, it rallies up from 70 to $75 a share and is trading above $75 a share at expiration, then the person that I sold that call to, well, they've got something valuable. They're able to buy the stock at 75 when it's trading above 75. Great. That's good for them, but it's good for us too. We bought the stock at 70 and now we're selling it at 75. And I realize there's arguments to that statement. One argument is, okay, yeah, if it's above 75, what if it zipped up to 200? Well, that kind of stinks. You left money on the table in that case. But most stocks don't do that. And for the one cog in the wheel that does do that, it kind of stinks. But for the other 200 cogs that you trade in a year that didn't do that, they typically more than make up for that one. Not guaranteed, but typically they do. That's what the studies show. So if the stock is above 70, if I own the stock at 70 and it's above 75, so I sell it at 75, how much do I make? Who's going to be first here? You know, those of you who have attended my Firstrade sessions in the past, you know that sometimes I give away prizes to people who answer. I give nice swag packages. Boom, Michael. $700. Damn. Michael's right. Boom, boom, boom. On the money, baby. All right. Michael, send me an email. I'm going to send you a swag package. Dan@markettaker.com. And I'm talking like physical, like give me your home address. I'm going to put it in the mail and it's going to be some cool stuff. I'm not going to tell you what it is, but if you want it, that swag pack is yours. So Michael said 700. See, I thought I was going to trick some people here. You know why? Because I said, it's all how you phrase things, right? We call it pre-framing. I buy at 70, sell at 75. How much do I make? Boom, I got the right answer from Michael and Secret Agent Man, autonomous attendee. Not autonomous. I mean, I hope you're autonomous. Anonymous attendee. So Michael didn't fall for my little trick. He said $7 or $700. Why? Because not only did I buy the stock at 70 and sold it at 75, but I also get to keep that $2 that I sold the call for. So the most I can make is $7 a share, which is $700 of money. Okay, what if, friends? What if the stock is below the strike at expiration? Now, keep in mind here, the stock already was below the strike. So I'm not saying the stock goes down. I'm saying the stock might go down, might stay where it is, might even go up a little bit. It's just below 75 at expiration. Well, if it is, then what happens? Then my break even or my effective purchase price, or the way I phrased it before, cost basis is $68 a share. Now, what does that mean? Is cost basis, what does cost basis mean? Well, I'll tell you one thing it doesn't mean, and this is very important. It has nothing to do with taxes or anything like that. That's a different use of the word cost basis. This is our break even. If I bought the stock at 70, but I have $2 that, assuming the stock is below 75, the call is going to expire and I'm going to get to keep that $2. I basically own the stock at 68, right? It's like I bought a barbecue grill last year for, we have a summer home in New Buffalo, Michigan. I bought a barbecue grill for it. I went up to Menards and it just so happened, it was kind of a coincidence, just so happened that they were having some sort of special. You buy this brand of barbecue grill, which when I say brand, I mean, there's only like a couple of brands out there. Like you go to the store and there's like 15 brands, but they're all literally exactly the same one. It's just got a different logo on it. All made in the same factory in China, right? Well, it just so happened that the brand that I was shopping for had a rebate. You buy the grill for 500 bucks and you get a $50 rebate. Okay. How much am I paying for the grill? I'm basically paying 450, right? That's my cost basis for the grill. I mean, I have to factor in that rebate in my head. When I pay, I actually pay 500, but I get that that $50 back as cash. It's the same darn thing here, except you get the rebate the same day. You give them 500 bucks cash. Who has 500 bucks cash? Does anybody have 500 bucks cash on them? Nobody has 500 bucks cash on them, but let's just pretend. You give them 500 bucks cash. They say, thank you very much. And here's your $50 rebate. It's two different things, but it all comes out to 450. That is what we're talking about here. We owned the stock at 70. That's this black line. If it goes up a dollar, I make a dollar, down a dollar, I lose a dollar. But with the covered call, the darker green line here, I also get to keep the $2. So what does this mean? It means I always outperform long stock by the $2 of option premium, presuming we're below the strike price. In fact, I actually outperform all the way up to $77 a share, not necessarily by $2. $77 a share is a strike price plus the call premium. We call that the indifference point. Okay. So we have this risk reward scenario here. To the upside, meaning if the stock goes up, I have limited profit potential and I might get assigned. And if I don't want to, getting assigned means I have to sell the stock at 75. The person who owns it exercises. We are short the call, so we might get assigned and have to sell the stock at the strike price. If we don't really want to sell the stock at the strike price, we need to actively manage, kind of pay attention, and maybe do what we call an adjustment. To the downside, meaning if the stock goes down, what I got going on there? Well, it's the same risk as owning the stock, but at a slightly lower cost basis. There's a misconception out there that covered calls are risky when stocks are going down. And on the surface, that is definitely true. That is definitely true. You when you own a stock and the stock goes down, you lose money. But when we're comparing it with owning the stock by itself and owning the stock as part of a covered call, there is undisputably less risk in down markets owning or having the covered call position because we get that rebate from buying the barbecue grill. And this one trade is just one cog in the wheel. We're going to get another rebate next month. It's the gift that keeps on giving. Now, the stock goes to zero 3 days after you buy it. Well, you know, that's another one of those where, boy, that really stinks. But if you liked the stock, the alternative is you would have just bought the stock. You might have got really creamed, but you got less creamed, a little bit less creamed than if you just plain bought the stock. So let's talk about some of these things. Managing to the upside. Well, if the stock rises through the strike price, we got good news and we got maybe bad news, probably not really bad news. It's mostly good news. The stock rises through the strike price and is still there after expiration. We made money. Made $700 of cash. Bad news? I don't know. I mean, if the stock is trading significantly higher, I left money on the table. But if you're in the practice of when you buy a stock, putting in a good till cancel order to sell it, I mean, that's kind of the same thing too. But I don't have to sell it, even if it's in the money. I mean, don't get me wrong. There are some times where you get surprise assigned. That doesn't happen too often. Usually you can avoid assignment. You can't always. Usually you can avoid assignment though by managing properly. I can either wait for assignment and just let it all happen organically, or I can buy the short call to close it. I don't have to keep that short call on forever. I don't have to hold it through expiration. I can close it before expiration. And if I do, I can also sell a new call up at a higher strike and out to a longer term expiration. It's called rolling up or out. Secret agent man here says, if the stock goes down to 60, do I get paid 62 for it? Yeah, well, let's go back and take a look at that. So remember, you today, you buy the stock at 70, 100 shares. That's $7,000 goes from cash in your account, and now you own the shares. Today, you buy it at 70. And today, you get $2 from selling the call. So you're effectively in the stock at 68. If the stock goes down to 60, this is the way to think about it. I basically bought it at 68. Now it's at 60. I lose $800, $8 a share. Does that make more sense? I think you're thinking about it just a little bit from a different perspective. Does that make more sense now? Now, this, once you get the hang of it, like when you first start doing anything, you have questions, You're not sure exactly what to do when some things like just don't immediately click. Once you get the hang of it, you'll find that you probably don't really have quite the hang of it. There's like different stages to learning from my experience. You learn, you get these basics down, but then you got the practical stuff. And then you've got the nuances of the practical stuff. It's like an S-shaped learning curve, but there's several S-shaped learning curves. So a lot of times people say, oh, okay, I got it. Because they watch a presentation that covers nothing but what I just said. And they figure, oh, it's easy. But they find that it doesn't work. They net lose money. Stocks are going down, or stocks go up too much, they leave money on the table. They actually underperform. Why is that? One, and Howard, you've got a good question. I see it. I'm going to get to it in a second. One, they're doing it on the wrong stocks. This is an augmentation to the long-term buy and hold conservative investment strategy. When you buy a stock, why do you buy the stock? Do you buy it because somebody on TV said it would be a good buy? Or I subscribed to some service and they said it was a good buy? Or look at this chart, it looks like it's going up. Or, man, I use that kind of razor. It's the best razor I've ever used. I'm going to buy stock in their company. I would say all these reasons that I just said aren't the best reasons. We want to, we can start there to get ideas of what to research, but we got to do the research. We got to think about the things that I talked about earlier. We got to think about some of the financial ratios, or hey, put in the time and read some books. If anybody wants to email me later, Dan at markettaker.com, or just go to my website and contact me through the website, markettaker.com. I'll give you some book recommendations on fundamental investing that are great. You are welcome, Secret Agent Man. Um, oh, Howard, I just accidentally deleted your question. Don't let me forget to answer it. You, if you do it on the wrong stocks, if you're doing it on the wrong stocks, stocks that you didn't really do your research on, you've got no objective reason to think they're going up besides, oh, somebody on TV said it was good. We want to always have a fundamental or a technical actual reason. We also want stocks typically above 20 bucks a share. I will do them sometimes on stocks less than 20 bucks a share. In fact, I've got a covered call on right now on TMC, the Metals Corporation, um, which is like a $5 and change stock. But normally I like to see them above 20 bucks a share. Also, it might, instead of being the wrong stock, it might be the wrong option. I could have a lack of edge on the option. Also, it could be poor management. Every one trade is a cog in the wheel. Am I thinking about it that way? Am I thinking about trading in a cycle? Held through earnings. We a lot of times like to avoid earnings. Not always, but a lot of times. Sometimes people trade without a plan or without even an objective. Hey, am I selling this covered call because I just want to skate and keep the premium? Or am I selling this covered call with the objective of trading out of the stock, thinking about it like a limit order? Those are actually contrary to one another. Did I trade the wrong strike or the wrong expiration? Am I just trying to pick up a thing here or there in a webinar, which is a great starting point? I mean, man, I put in a lot of time working on putting these presentations together for you, as do the people at Firstrade. I mean, it is amazing that they give you all this free training, and I'm proud to be part of that. But you know, you want to get all of the training. You want to have enough training to be not just enough information to be dangerous, but enough information to be great. So get that training. All right. So let's first talk about out of the money calls. And Howard asked a couple of questions, and they're both really good questions. So let me just take a second and answer them. One is, are low volatility stocks the best to own? Generally, the answer is yes, but not. When I say generally, I don't mean 99% of the time. I mean like 65% of the time. The answer is yes. There are some cases to be made for high volatility stocks, and I love trading covered calls on those sometimes. They're a little bit harder. They can be a little more frustrating, but they can pay off better too. So generally the answer is yes, but there's a lot more to it. Howard's second question, what is the procedure if the stock goes to 60 at expiration? Buy more, hold it. So for that, we want to shift our thinking from forget about the covered call. What would I do if I was not trading the covered call? What would I do if I'm just purely looking at this as an investment? And Obviously, there's not always one single answer to that question. There are sometimes on some investments where, especially if I'm looking at it fundamentally, technically, from a technical analysis standpoint, you would never buy more if it goes to a cheaper price. That's called catching a falling knife. From a fundamental standpoint, a lot of times you will buy more if the stock goes to a lower price, and that's called average pricing. So it kind of depends on if you're looking at it technically or fundamentally. It depends on market conditions. If the market's in a free fall, depending on what part of the free fall we're in, that answer is going to change. If um, if you're looking at it fundamentally and you bought some, but not your full size, like what a lot of investors will do is they'll say, "Hey, I've got you know, a $500,000 IRA that I've saved up my whole life. Um, I'm going to put no more than 10% in one of my stocks, in any one stock." Well, if I've got 5% of my account in this position that I bought at 70 and now it's at 60, and I bought it fundamentally and it was a good value deal at 70, now it's at 60 and it didn't have new earnings information, nothing's fundamentally changed, then that's a situation where most investors would buy more. And as you can imagine, Howard, there's even more answers to that, but that's all I have time for. Okay, out of the money covered calls. This is the most common technique because it's for, when investors have the buy and hold strategy, it allows for the biggest share price appreciation. The stock can go up to the strike price and you make money, and your call can still expire worthless. This is basically just augmenting the long stock investment. Here we're looking for upwardly trending stocks, but maybe not at its all-time highs. It's still got room to rise. So we want to set the strike at or above resistance. We generally want to sell a 1 to 6 week option because if it's close enough to the money, it has the highest theta. And we want a minimum premium requirement of at least 0.5% of the stock price. In my upcoming book, which will be out, they tell me April 28th of 2026. So those of you who are watching this on the recording, hey, maybe the book's out now. There's some more math, but it would be basically a whole webinar going over the math of this. But at a basic level, at least 0.5% of the stock price. And in a perfect world, we want to sell an elevated implied volatility. So let's say there's a $90 stock. It's on a pullback in a steadily rising trend. There's resistance at $95. I own 100 shares at 90, or I'm just buying right now 100 shares at 90. I sell the 95 strike calls because that's at resistance. This happens to be about 2.5% of the stock price. Okay, so, and just going back there, what would I make on this? Well, I own it at 90. If I get assigned, I'd sell it at 95, so make $5 there, plus 210, I'd make $7.10, best case scenario. Okay, let's look at the money covered calls. This is what Howard was asking about earlier, and it's a really, really great topic of conversation. This is, generally speaking, a more aggressive technique, though not always. A lot of times I look at it as a really conservative technique, especially if they're longer term options. This is when I'm going out like a year in time or so. And when the implied volatility is really high, these can be very strategic plays. And I would say not really aggressive. I'd say even more conservative than a regular one. At the money options have the biggest time value. So that means it lowers the cost basis the most. Because we haven't talked about in the money covered calls yet, but we will in a second because those are valid also. Within money covered calls, the intrinsic value of the call doesn't matter to the cost basis. It's only the time value. As far as lowering the standard deviation, intrinsic value also doesn't matter. It's only the time value. And if the stock is not called away, if you don't get assigned, it outperforms the most. It benefits you the most to the downside. So there's a lot of great advantages with the at the money covered call. Is there a disadvantage? Potentially. There's more assignment risk than the out of the money covered call. But if you're okay with getting assigned, that's not a disadvantage. Also, there's no room to run, is what we call it. Room to run from where I own the stock up to the strike price because the strike price is not up. It's at the same price. Is it a good idea? Is it a good idea to buy stock when at the bottom of a Bollinger Band? Howard, that's going to be off topic. But that's more of a trading. The way I see it, that's more of a trading scenario. It could be used as an investor, but I would use that with other technical and or fundamental criteria. But I mean, the answer classically is yes, because that's where it's gotten to the point of being 2 standard deviations away, and we tend to see it. We tend to expect it to retrace at that point. But okay, so this we use in upwardly trending stocks, but not at its highs. We set the strike at the money with I say 1 to 45 days, but actually, I'll tell you the truth. I like at the monies. I use at the money covered calls in, I can think of off the top of my head 2 reasons. One is, hey, I'm at the point where I kind of want to sell this stock, especially if like last week I sold an out of the money covered call and it rallied up to my strike price. And I'm like, okay, well, this stock's getting to the point of being overpriced. I'd probably sell it here. Although if it goes back down, it pays a good dividend and it's an okay dividend yield. So I would just keep it if it goes back down. I love selling at the money covered calls in those situations. And if I get assigned, okay, bye. And if I don't get assigned, okay, keep it, do it again. Now selling out the money. Or sometimes I'll sell a very long-term covered call at the money where where sometimes like it could endure a 12% increase. And I don't think the stock's likely to go up more than 12%, but because it's at the money, that means it can also endure a 12% decrease in price before I lose money. And I'll just be like, yeah, okay. I don't think the stock's going to go up more than 12%. If it does, that's fine. The market's expected to make 10% on average, not every year, but on average. So I beat the average. And if it goes down 12%, I would love to buy it there. That is when I use an at the money covered call the most. Here I usually want at least, I'm saying at least 2% of the stock price. But if we're talking about a long-term covered call, what I'm really looking for is an annualized return of at least, depends on the situation, but probably at least 12%, probably more though, probably closer to 20% if I can. And I always like to sell elevated implied volatility. Okay. Scenario. There's a $110 stock in a steadily rising trend. Okay. So I own the shares at 110. I'm going to sell the 110 calls at 280. Okay, let's look at an in the money covered call. This is an underused strategy. People look at me, they give me the hairy eyeball when I start talking about in the money covered calls. Like, what are you talking about? In the money covered calls. Why would I do that, Passarelli? There's some good reasons. This is an investment management technique. And like I said before, only time value lowers standard deviation, reduces cost basis, and leads to outperformance. Intrinsic value is basically it offsets the share price. Think of intrinsic value, and this is not like this is a true statement, but it's a true statement when looking at it through a certain lens. Think of intrinsic value as the hedge part and the time value as the trade benefit. This is an exit strategy. We're assuming we'll be assigned because it's more likely if it's in the money, it's got a delta over 50, meaning we have more than a 50-50 chance of getting assigned. And a great way to think about this is through the lens of synthetics. Cash secured puts and covered calls are synthetically related. A lot of people, this is not always crystal clear to a lot of people when they first think about it. In fact, there are some people who will just knee-jerk reaction, tell me I'm wrong for saying this until they think about it more. The key here is that if it's the same strike, so like if there's a stock at 100 and I sell the 90 strike cash secured put, okay. If there's a stock at 100 and I sell the 90 strike call and I own the stock, those are both the same position, the cash secured put and the covered call. They function the same. There are some important differences, like one, I collect dividends, one, I'm missing out on interest. But outside of some of these nuances, they perform identically. So let's say I've owned a stock for a while, and this is an investment I'm looking to sell. I want to generate income. I want to sell it at a better price than the current stock market. Well, I can set my strike at support and sell a 21-day or less option. This, we definitely want to keep it under 3 weeks. I prefer to keep it under a week and a half if I can. And I want to collect at least 1% of the stock price in time value, not total option premium, but only the time value portion. So basically, I subtract out the in the money amount, and anything that's left over is time value. I want usually at least 1% of the stock price. I'll do it for less sometimes. And I tend to want to sell at high implied volatility. So I have a stock investment. I might have bought it last week. I might have bought it 10 years ago. And I don't want to own this anymore. Maybe I owned it for a good dividend yield and the stock has risen so much and that it's a bad dividend yield, and I don't expect them to raise the dividend. Well, it's not doing what it was doing for me anymore. I could get a better dividend yield somewhere else. I think I'm going to sell this stock. So I own 100 shares at 63 bucks. I might sell the 60 strike calls at, say, 390. Okay. So this is where I got to do a little bit of simple arithmetic. If the stock's at 63, how much are the 60 calls in the money? They're in the money by $3. It's $3 of intrinsic value. So the time value is 90 cents. Okay? The time value is 90 cents. So that's like 1.5%, right? Because 63 cents would be 1%. So the $3 is the hedge. Stock can fall all the way to 60 and I still get assigned. If it falls below 60, hey, I might be back in the area where, it's a good value investment. I don't want to sell there anymore. But I get to keep the 90 cents either way. All right, friends. Hey, I hope that helps. Gosh, I love talking about covered calls. That's all I talk about, think about every day of my life these days. Next week, friends. Oh my gosh, guess what? Next week, we're talking about trading the wheel strategy. So we're going to expand and expound upon the things we covered today. And we had a pretty good turnout today. So I'll see you all next week when we go even deeper into the wheel. This is Dan Passarelli. Trade smart. Bye.